Yeah, good evening, Dr. Chetan. Am I audible, Dr. Chetan?
Yes, sir, you're audible.
Good evening. Am I visible?
Yes, you're visible as well.
Good evening to all.
So, yes, sir. So, with your kind permission, shall we start off this?
Yeah, please proceed. Already 6:05.
Yes. So, participants are also joining in. So, let them join. So, it's 6.
No, I think it is up to Mr. Saurabh Mukherjee. If he agrees to start, fine. From my side, no problem. He's the main speaker.
Our privilege to be here.
Yes, sir. Thank you so much, sir. So, with your kind permission, I'll start.
Yes.
So, before we start off, let us hear out a famous quote of Benjamin Graham about investing. The quote is, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. So good evening to one and all present here. Today we all have gathered here for the webinar of Mr. Saurabh Mukherjee, Mr. Rakshit Ranjan, and Mr. Salil Desai on the topic Investment Philosophies of Marcellus Investment Managers. So we're extremely honored and feel privileged to have all of you for this webinar. So I welcome all of you on behalf of MDI Murshidabad. I welcome Professor Dr. Atmanan, Director MDI Murshidabad, for being present for this webinar. I welcome Professor Biranchi Narayanswar, Dean Continuing Education. I also welcome all the professors, non-teaching staff, and my dear students to this webinar. So now I proceed to introduce Professor Dr. Atmanan, Director MDI Murshidabad. So Professor Dr. Atmanan is a renowned economist, administrator, and academician, currently working as Director of MDI Murshidabad. He also worked as Director Additional Charge of MDI Gurgaon. He was also the Independent Director of Central Bank of India, SAIL and PTC India Limited. Dr. Atmanan's experience in teaching, research, and consultancy is more than 34 years. He is one of the longest serving deans of India. He has taken many new initiatives like the launch of MDI School of Energy Management, Journal of IMT Ghaziabad, and established MDI Murshidabad, to name a few. He has contributed to various national responsibilities as member of the State Finance Commission, Government of Bihar, Planning Commission, Government of India, and as member of other task force, Cabinet Secretariat, Government of India, member of Review Committee, Ministry of Ayush, Government of India, member of Advisory Committee, Ministry of Power, Government of India. Dr. Atmanand has authored 16 books and published more than 100 research papers in refereed national and international journals. He has undertaken several consulting assignments in the area of energy, insurance, infrastructure projects, social development, leadership, etc. He specializes in the public enterprise management of energy and environment, power, oil and gas, steel, financing infrastructure projects, project finance, economic and business environment, public policy and management. His contribution of many years has been recognized in the form of awards like Rashtriya Gaurav Award for his excellence and contribution in the national building, Indian Achievers Award for the Corporate Leadership 2010, Economic Development Award of Excellence in Higher Education 2011, Exemplary Global Leadership Award 2010, and appreciation letters from various departments like the Ministry of Power, Government of India, and SAIL. Dr. Atmanan's vision statement is to have people around him who are thinkers and doers in one person. He spreads the policy of connect, nurture, and grow. With this, now I would request our director, sir, to say a few words to the audience out here. To please address
Thank
the
you.
gathering.
Thank you very much, Professor Biranchi, for your kind words. Dear participants, good evening and warm welcome to you all. I am pleased to welcome you all to the webinar talk series of MDI Murshidabad on the topic Investment Philosophies of Marcellus Investment Managers, who are with us today. I take this privilege to welcome our experts for today's webinar, Mr. Saurabh Mukherjee, who is the founder and chief investment officer of Marcellus Investment Managers, Mumbai, along with Mr. Rakshit Ranjan and Mr. Salil Desai. I also take this opportunity to congratulate Dr. Chetan GK for organizing this very important webinar. Thank you, Dr. Chetan. It is my privilege to welcome and introduce you all to MDIM. MDIM's vision is to be an internationally excellent business school known for our academic ambition and influence in building a responsible future for both business and society globally. We are highly focused to create an ethical and knowledge-centric culture that values outstanding academic excellence, training, research, and consultancy. Dear participants, MDIM has initiated the webinar talk series for their students, faculty members, and all other stakeholders. During the last 2 years and more, several webinars on multiple topics have been organized by national and international experts of industry and academia. Today's webinar will cover the various aspects and salient features of investment, the strategies involved in it, the importance of macroeconomic variables on investing, and how to develop an investing mindsets and so forth. And therefore, today's webinar talk by the experts present on the panel will definitely help the students to refresh their understanding and knowledge about financial investments and the various dimensions of the financial investments in the real world. To know more on the topic, let us get the inputs from our experts. Thank you. Welcome, Mr. Saurabh Mukherjee, Mr. Rakit Ranjan, and Mr. Salil Desai. Thank you.
Thank you, Dr. Atman.
Thank you so much, sir. So thank you so much. So now I would request Professor Biranchi Narayaneswar, who is Dean Continuing Education, to speak few words on this occasion. Over to you, Professor.
Thank you, Dr. Chetan, and good evening, Director Sir.
Good evening.
On the behalf of MDI Murshidabad, I welcome Mr. Saurabh Mukherjee and their partners, Mr. Salil Desai, to this particular event. And as you know that it's a great opportunity for our students to learn out of the delivery which will be there today by Mr. Saurabh Mukherjee and his team. And it is indeed a pleasure, to invite such a great stalwart in the area of investment. And it is a very landmarking journey, going abroad, establishing himself and getting a lot of laurels for the country like India, and writing a very good book. I was just going through Diamonds in the Dust. So this is a landmarking, contribution from Mr. Mukherjee and team for the literature of investment. And really it will help a lot to all the investors across the globe. And at the outset, our students will be benefited out of the learning which will be happening for another some time from now. And I wish all the very best to Dr. Chetan for organizing this particular interaction. And I wish also that Mr. Saurabh Mukherjee will keep on giving a lot of knowledge in terms of investment times to come. And we are eagerly waiting to invite you sometime down the line to our campus as well. As you are talking about, I could hear some time back, you are talking about the Palasi War and which is
Battle of Plassey.
that. So this is a historical place. So we will love to welcome you at any point in time, you along with your team members. So with this, I'm wishing you all the very best. And
Yes.
over to Dr. Chetan. Thank
Yes,
you.
Dr. Chetan, I also joined with you all in extending
Sure.
my heartiest congratulations to Mr. Saurabh Mukherjee, to Mr. Rakshit Ranjan and Mr. Salil Desai for publication of their book, Diamonds in the Dust. In fact, this book is available. I would rather sincerely recommend Dr. Chetan to buy a few copies of this book. If the soft copy is available, thank you very much. I can see it, Diamonds in the Dust, in our library, so that our students can also read it, so that it is not a dust, it is a diamond. So how can you say that diamond in the dust? Agreed. It's a very bright and it is very much visible. So let the contents and the information which are contained in this book be shared with our students, and I hope Dr. Chetan will sometime take a book review, or Mr. Saurabh Mukherjee will present the book review, sort of salient features of this book, and can talk to our students and make a very interactive session. Thank you very much, Saurabh.
Thank you.
Congratulations.
Thank you, Director Sir. So yes, our students are quite crazy after reading your Coffee Can Investing and Diamonds in the Dust books particularly. So there was a huge pressure which has come from the students, in fact, to call Mr. Saurabh and his team for this webinar. So last year, same time, we had Vijay Kedia sir also, who is actually coming and interacting with the students. It was really immensely value adding, even his speech as well. So I know Mr. Saurabh is from Kolkata, so his roots are in West Bengal. So definitely, whenever maybe Mr. Saurabh is there in Kolkata next time, I think we are inviting you, sir, to MDI Murshidabad. It's just 5 to 6 hours journey it is from Kolkata.
One day, look forward to visiting Murshidabad.
Yes, sir. Yes, sir. So now I proceed to introduce for today's guests to the gathering out here. So Mr. Saurabh Mukherjee, Mr. Rakshit Ranjan, and Mr. Salil Desai are part of the investment team at Marcellus Investment Managers, a SEBI regulated and provider of asset management services. I would now like to introduce Mr. Saurabh. Mr. Saurabh, a fellow of Royal Society of Arts and an alumnus of the London School of Economics. He's the author of 4 best-selling books on the subjects including investing, business strategy, and self-improvement. Prior to Marcellus, he was the CEO of Ambit Capital, and before that, the co-founder of Clear Capital UK. Saurabh manages Marcellus Investment Managers. So thank you, Mr. Saurabh. We have got many other a lengthy introduction. In fact, I have with me, but because of the time constant, I'm just going ahead with a small introduction of yours. So please pardon me. So next is we have with us Mr. Rakshit Ranjan from the Marcellus Investment Managers. Mr. Rakshit manages Marcellus flagship Consistent Compounders Fund, a BTech from IIT Delhi and a CFA charter holder. He has a total experience of over 16 years in equity investing in UK and in India. He is also one of the co-authors from Saurabh for the book Coffee Can Investing. Thank you, Mr. Rakshit, for joining us today. So along with us, we have today Mr. Salil Desai from Marcellus Investment Managers. Mr. Salil, a chartered accountant and MBA, and has spent over 16 years covering diverse sectors in the Indian equity markets, including at India's largest family investment office. He manages some of the large advisory portfolios at Marcellus. MDI Murshidabad is indeed blessed to have all 3 personalities joining us today for this webinar series. So all the participants, I request to type in your queries in Q&A section. So now all the stage is yours, Mr. Saurabh and team. Over to you. Saurabh ji, I think it's frozen. I'm audible.
Yes, you are audible, Dr. Chetan.
Yes. Okay. So Rakshit ji, you can take over the stage. Now it's all yours.
All right. Great. So, thanks to MDI Murshidabad for inviting us to talk about Marcellus Investment Managers and our latest book, Diamonds in the Dust. So Penguin published this book about 1 year ago, and it has straight away gone to #1 on Amazon's initially the new releases and now Business and Economics. I think we've sold more than 100,000 copies in the official channel now. Sorry, we're back.
Yeah. Sorry about that. My internet died. Internet switched to another line. So sorry about that. Thanks, Rakshit. Thank you for managing the internet drop off. So since Dr. Chetan has already introduced Rakshit, Salil, and myself, just quickly 9,000 Indian families, Rakshit, Salil, and 120 other people. For 9,000 Indian families, including, say, the Indian Navy's pension fund, we look after around 13,000 crore of savings. And we invest that money on 3 very simple principles. We look for clean keys, promoters who are not stealing money. We also look for promoters who are rational, i.e. people who run businesses sensibly rather than buying private jets or cricket teams and so on. And thirdly, we look for families or promoters who are not just clean, not just rational, but also dominant. In simple English, we look for monopolies, right? That's the philosophy. Now, every fund manager has a philosophy. Dr. Chetan mentioned, other luminaries have spoken to you guys. Other people in India, for some reason, don't write books. So why do we write books, right? Why do we spend, each book takes around 2 years to put together? Why do we put these books together? It's clearly not for the money. What we find in our country is there tends to be a lot of excitement about the stock market. There are plenty of youngsters on this Zoom call, and I'm sure the youngsters will agree. There's lots of excitement about investing in India these days. But forget newcomers, forget youngsters such as the people on this call, even seasoned investors in the Indian stock market, even veterans of the Indian stock market, don't understand how difficult it is to consistently make money in the Indian market, right? And our whole goal of writing is to help people understand the risks involved and how to actually make money consistently in India. Just to give you a sense of how difficult it is to consistently make money in India, we just showing you half a dozen numbers on this screen, right? So if you want to look at the good news is over the last decade, the Indian stock market has created over $1 trillion of wealth, right? That's a tremendous achievement. A decade back, market cap was 2 trillion. Today it is 3 trillion, right? So $1 trillion of wealth has been created. There are 6,000 companies listed in the Indian stock market, and clearly $1 trillion of wealth creation is a stupendous number. The bad news is no more than a dozen or so of these companies drive 80-90% of the country's profits, and they drive 80-90% of the wealth creation in the stock market, right? So 6,000 companies listed, but basically a dozen companies make all the money, right? And that makes India a very polarized stock market. And you can imagine, right, if only a dozen or so companies make all the money, you can imagine the implications. So if you look at the stock market as it stood a decade ago, if you had looked at the BSE 500 as it stood a decade ago, half the stocks that were listed on the BSE 500 a decade ago are no longer in the BSE 500, right? If you looked at the BSE 500 as it stood a decade ago, 85% of the stocks in the BSE 500 as of a decade ago failed to give a return on capital above the cost of capital, right? Assume cost of capital is 15%. 85% of companies failed in that regard. And forget the BSE 500, look at the Nifty 50, India's premier benchmark. 70% of companies in the Nifty failed to give a return on capital above the cost of capital, right? So Dr. Atmananji was asking, why did we call the book Diamonds in the Dust? The dust is the Indian stock market. The vast majority of stocks in the Indian stock market are no better than dust, right? Useless hai, dhool ki tarah hai. Your and my job, the students at MDI and the staff at Marcellus, our job is to look for the dozen or so diamonds in the Indian stock market. And as you can imagine, looking for diamonds in the dust is a difficult process. So how does Marcellus do it? How do we consistently compound our clients' 13,000 crores? I'll request my colleague Salil to take you through the journey.
Thanks, Saurabh. Right, so like Saurabh was mentioning earlier, there are 3 essential steps to our investing process. First is clean accounts. Second is to look for companies with competitive advantages. And third is to look for companies with good capital allocation. The first step is arguably the more important one, or the starting point, right? Now, generally, what happens is when we think of clean accounting or we think of accounting frauds, the perception is that these happen rarely, right? These happen at frequencies which should not really worry us. So, say the Satyam scam, which is one of the most popularly cited example, happened in 2009, and ILNFS happened 10 years after that. But is that the case? The answer is no. Accounting frauds are more frequent, and they happen across a spectrum of companies, right? Which should worry us, right? Let's take 3 examples which are cited in the book extensively to get a sense of what scale of frauds happen across different sizes of companies. So the first example we have is Dewan Housing Finance Limited. This used to be a company in housing finance. At its peak, the company had a market cap of 20,000 odd crores. Now, when a forensic audit was commissioned on the company, it was found that the promoters had siphoned off 17,000 crores from the company over a 3-year period, right? So 85% of the market cap, or an amount equivalent to 85% of market cap, was taken out of the company over a 3-year period. That's the scale of fraud that we're looking at. Then there was a company called Decan Chronicle. At one point used to be one of the largest English language newspapers in India, especially in the south of India. From one year end to the other, the company had to restate its debt up by 5 times. Right? So the debt, which was actually 1,000 crores, turned out to be 4,000 crores. Right? So investors would have bought thinking that 1,000 crores is a manageable debt for a company of this size, would be shocked at the end of 12 months to figure out that it's actually restated up by 4,000 crores. And then the third is a company called Cox and Kings. This used to be a leading travel services company. This company, from a positive net worth of around 4,700 crores as of March 19, after 12 months, and by March 20, the net worth had gone down to a negative 7,300 crores. Right, so we are seeing a 12,000 crore swing in net worth, positive to negative in a 12-month period. Right, so 1,000 crores of net worth getting wiped off every month. Now, you would say, okay, this is fine. Is this just an academic exercise to know what scale of frauds happen in India? The answer is really no. Let's see why that impacts us and why you and I, people like us, retail investors, should worry. The number one reason to worry is that most of the times, in fact, we would say 90% of the times, it is the retail investor who gets the short end of the stick here. So let me draw your attention to the chart on the left. Right, this is the stock price chart of DHFL, the example we saw in the earlier slide. Now, when concerns started emanating that there's something wrong with the books, the stock price kind of dived or started declining. So much so that in a single day, there was a 40% fall in the stock price of DHFL. Right, so what you thought was worth 100 rupees today becomes worth 60 rupees tomorrow. And now, what happened after this 40% decline? You see the dotted line on the chart. That's the retail shareholding in the company. After the stock falls, the retail shareholding starts climbing and ends up nearly to 50%, right? Which means the retail shareholders, like people like you and me, ended up holding half the company. Now, today, the DHFL stock is worth zero. It has been delisted. It has been taken over under the insolvency proceedings by the Piramal Group, and retail investors have got nothing for the equity that they invested in. Right? Now, there are 3 typical ways in which investors get trapped. Right? The first is that they don't really have the ability to assess if there is something wrong in advance. Right? So they don't have the accounting tools or the forensic tools to figure out that if there is something wrong. If you suspect there is something wrong, then obviously you will not go and invest. The second happens after you invested. The people are aware that, or the investors are aware that there is something fishy going on, but they think that we'll exit in time. Right? We'll exit just before things start going south. But that rarely ever happens, because when concerns start emerging, like you saw, there's a 40% decline. The third and the most common reason how investors get trapped is that the stock price falls after the fraud is out in the open, and everybody starts believing that this is a cheap stock. Right? What was available at 100 yesterday is available at a 40% discount today, is what people feel, and then they go and invest. But in case of large accounting frauds, turnarounds are rare. You will very, very rarely, if ever, recover your money. So what you need is a forensic accounting and a governance checklist. Right? In the book, we have detailed both of these, given checklists on what to look for, what not to ignore, what are the critical aspects, and so on. So this is basically the very first step. Now, this tells you what you should not be doing, where you should not be investing. Right? So the second question is where you should invest then. Right? So I'll request Rakshit to take you through those parts. Rakshit, over to you.
Thanks, Salil. So folks, when it comes to generating outperformance versus the broader stock market, an interesting data point about India's stock market is that to begin with, indices such as Sensex and Nifty, they themselves do not outperform India's nominal GDP growth rate, despite benefiting from massive survivorship bias and selection bias. You can imagine only companies that survive through the competitive dynamic and become larger get included in the index. And despite that, the lack of outperformance of the index over nominal GDP growth, we believe, is largely due to the dodgy accounting practices followed by many large and dominant businesses in India. And hence, there's a massive outperformance for a stock investor to be had only by focusing on clean accounting practices itself, right? And in addition to clean accounting practices, alpha also needs to come from picking up companies with high quality fundamentals. And on that point, there are three characteristics of a high quality company which an investor needs to target. The first one on the left of this slide is that the firm needs to have a high pricing power. Now, what does that mean? Pricing power just doesn't mean the ability to hike prices in order to protect margins in the face of rising raw material costs. That's part of the definition of pricing power, but it also means that even if a competitor kicks off a massive price war by offering competing products at say 30 or 40% discounted price points, then that should not lead to any adverse impact on their market share or profitability of a great franchise. And in Diamonds in the Dust, there's a chapter we've provided with a total of 10 plus case studies on companies with high pricing power, such as say a Pidilite, a Divi's Laboratory, Karvare Technical Fibers, etc. The second characteristic of a high quality company is that the outcome of high pricing power, which is high return on capital employed in effect, and hence strong cash flows, this outcome should get reinvested back in the business whilst sustaining higher pricing power of the overall business. Now, this is harder than it sounds because most successful businesses, they fail to maintain prudence while allocating capital to grow beyond their core products and markets. And again, in the book, you'll find in chapter 5, we've given a framework to assess capital allocation decision quality with more than 20 odd examples of prominent and successful Indian companies. Unfortunately, majority of them had an adverse impact on shareholder returns through capital allocation. The third characteristic of a high quality company is that these companies are institutions rather than one-man shows. In Hindi, we call it Lala Ji Ki Dukaan. The institution building at these companies, the lack of Lala Ji Ki Dukaan, it needs to happen at three levels. At the first level, the board of directors should be independent and high quality. The second level, the CXO layer should be high quality and should have a succession plan to groom talent as future CXOs. And finally, there should be decentralized execution at the ground level of the business. And in the book, we've given comparison between, for instance, an Asian Paints' board and HDFC Bank's board to measure and quantify the differences around this characteristic. This ends up being sort of one part of the exercise, but the outcome of this is that investing in consistent compounders, as we call it, it is actually very well summarized through these two exhibits. First and foremost, the exhibit on the left shows you that the rate of compounding is exponential. In the long run, compared to the broader market, where the rate of compounding would be sort of a 12 to 14% CAGR, and hence sort of 13 times compounding, as you can see at the bottom there, where Saurabh is moving his mouse. If you invested instead in consistent compounders, the rate is around 15 percentage points higher, closer to sort of 25 to 30%, and that means 100 times plus over a 20-year time period is the compounding that these stocks prices deliver. More interestingly, the histograms on the right-hand side, they show that when the 20-year time horizon is broken down into 12-month time periods, then first of all, unlike say the Nifty 50 index, these companies have very few instances of negative returns, even over a 12-month period, right? So you can see that the left half of the histogram on the top is pretty much blank. There was just 1 year FY09. Whereas for Nifty 50, the left half, the bottom histogram, is decently populated with around 6 to 7 years over the last 20 years, delivering a negative 12-month return, right? What's quite interesting about this histogram is even on the right-hand side, you see the sort of skew towards the rightmost column of more than 30%. And what that does to an investor is, let's say when you talk about a massive crash of 2009 and a recovery thereafter, if you compare year after year, the outcome and the tendency of an investor in a Nifty 50, let's say, right? The Nifty 50 did very well. FY10 was greater than 30%. You can see at the bottom right in the rightmost column, FY10 for Nifty 50 was greater than 30%. but then it wasn't consistent. FY11 was 10 to 20, FY12 was -10 to -20, FY13 was only 0 to 10, and FY14 was again a weak return, so on and so forth, right? So that's the volatile outcome after initial recovery of 2010 that Nifty 50 had. If instead you stayed invested in a consistent compounder, you didn't have to go through the volatility. FY10 certainly was +30. FY11 was also 20 to 30. FY12 was 20 to 30. FY13 was +30. FY14 was 20 to 30. You didn't have to go through a weak or a negative outcome in a consistent compounder for 5-6 long years after, say, the initial recovery of the global financial crisis happened. And that, in effect, becomes a very important point to take home, where the concept of profit booking or timing entry and exits, it actually is a risk that you don't have to play with if you invest in consistent compounders. More on this part from Salil in the next slide. Salil, back to you.
Thanks, Rakshit. Right. So just taking off from where Rakshit left off, right? In this slide, we are going to kind of focus on two things. The first is that you can't time the market, right? Very clearly, if somebody tells you that they can tell you exactly what is the time to buy or sell, don't listen to them. It's not possible. Second is, even if it were possible, right? So some kind of magic, the gains from stock selection are more than the gains from timing, right? I'll come to that later, but let us look at the first point, which is whether can you time the market or not. So let us look at a more recent example, which all of us will remember. And the chart on the top is of the BSE Sensex, right? From a period of say, December 19 to August 20, September 20. Now, on 14th of Jan of 2020, Sensex had recorded what was at that time its all-time high. And this was 14th of Jan 2020. And then, COVID, the fear of COVID started spreading. We saw the first case in India end of Jan and so on. The stock market started declining. Till 23rd of March, it had fallen by almost about 38%. 38% fall in the index in less than a 2-month period. Then on 24th of March is when the nationwide lockdown was announced, right? And what happened when the lockdown was announced? Everybody, right? Every single stock market commentator, economist, expert, everybody said that now the nation is shut down. Things will only get worse, right? Stock market should probably decline more from here. But that is not what actually happened. What actually happened was 23rd of March was the low. And since then, today, you know where the stock market is, right? We have seen the market nearly doubling from that low, actually more than doubling from that low. What this means is that what you would feel is, an obvious outcome of an economic variable is never really so. You can't time exactly what is the bottom, what is the top, what is the high, low, nothing. Right now, if you can't do that, then what should you do? Right? Which is what all we have been talking about so far, is selecting great stocks, selecting consistent compounders. So let us look at that. What happens, or rather, how the selection of consistent compounders takes out the timing equation. So let's look at the table on the right. So we have given kind of example from 4 stocks, right, 2 what we call as consistent compounders. So let us look at HDFC Bank and Asian Paints. Now, think of some person who is such a perfect market timer. He or she can figure out that every year, what is going to be the lowest point of that stock, right? What is called in stock market parlance as 52-week low. So this person for 10 years in a row exactly predicts the 52-week low of a stock of HDFC Bank and Asian Paints and buys on those dates, right? And he does so for 10 years, every year buying the same amount of stock. And then there is somebody else who thinks, I can't really do this, timing is futile. So what I'll do is I also want to invest regularly. So I might as well buy it on the 1st of January each year, right? I will not bother about what the stock price is at that point of time. So both of these guys do this for a 10-year period. And the end of 10 years, they compare their returns. Right? The perfect timer, right, has managed a 23% return in HDFC Bank and about 29% in case of Asian Paints. And what has the random selection guy managed? 21.2 in HDFC Bank and 27.5 in Asian Paints, which means that after trying out his or her luck for 10 years in a row, getting perfect timing for 10 years, this person has managed about 1.5% average excess returns. And what this tells you is that if you blindly buy a good stock on a random chosen day and do it regularly, your returns will not be materially different from somebody who claims to perfectly time the market, right? So the idea is to select the stocks. And if you look at the other two stocks at the bottom, you can see the return differential. Right? Where is timing relevant is because, or in cases which stocks are not consistent compounders, they don't earn a return on capital higher than the cost of capital, right? So the idea here is it doesn't matter what price you buy a stock at, when you buy it, whether you time it right, all that is immaterial. What you need to do is select good stocks, buy them regularly, and stay invested for the long term. Okay? Now, how does all of this eventually translate into an outcome for all of us? So I'll ask Saurabh to summarize it. Saurabh, please.
Thanks, Rakshit. Thanks, Salil. So folks, what we have tried to sort of tell you so far is basically, if I had to summarize, we've tried to tell you 3 things. When you invest your money, you have a choice, right? You have to do consistent compounding or you can do regular compounding. If you want to do consistent compounding, I'm sure a brilliant career awaits all of you when you leave MDI. Right? If you want to do consistent compounding, you have to do 3 things. Firstly, you're looking for clean promoters, right? Promoters who are not stealing money, right? So accounting quality is something you should serve. If I were you at MDI, I would read my accounting books as feverishly as I can. It will be an immensely important skill that you need to have if you want to enter the world of investing. The second one, companies for accounting, step 2 are companies who are charging 20 to 40% price premium in the market without losing a single competitor. And the third is you need to understand what high quality capital allocation is. Good capital allocation, strong pricing power, clean accounting quality. If you do that, you'll look like the fellow on the left. You won't have to worry about timing the market, trying to figure out which PE multiple to get in before the budget, after the budget, interest rate, Federal Reserve ke badhane ke pehle baad, all of that nonsense you won't have to worry about. You'll invest in high quality companies and compound at a good rate. If you don't do all of this, right, if you sort of shirk learning accounting, you don't understand pricing power and you don't understand capital allocation, then you will be like the fellow on the left, fellow on the right hand side, the crestfallen guy. He spends his whole career looking for sasta companies, low PE multiple. He looks for tips on timing. He tries to use interplanetary positions to time his investment. And obviously, his overall investment experience is an unmitigated disaster, right? So inside happy, consistent, inside standard investor, consistent discipline. If you are busy with studies, exams, soon you'll leave the world of studies and get very high-flying jobs. We are busy. So once you've written the book, we also understand very few people read books these days, right? WhatsApp se shiksha prapt ki jati hai aajkal. So in order to give you a tonic, right? In order to give you a fuel injection so that you do read the book, we asked our guru, Sir John K, to write the foreword of the book, right? And Sir John very kindly agreed, and I'll quote from the foreword so that you get a bit of motivation, right? Chavanprash ki tarah aapko josh mile kitab padhne ke liye. So Sir John says, no one said successful investment was easy. But this book will lead you carefully through the underlying principles. You'll learn to see through deceptive accounting. You will not learn how to time the market. Just to be clear, folks, you will not learn how to time the market. But you will learn that even if you were able to time the market by some prescience no one else has ever achieved, the returns from market timing are far less than the returns from effective stock picking. You'll learn the nature of comparative advantage and how to identify sources of comparative advantage that are appropriable and sustainable. To invest well, you must understand these things. I hope this book will encourage all of you to take charge of your finances. So we'll stop there. Thank you very much to the team at MDI, to Dr. Chetan, for giving us this opportunity to talk to all of you. So we've got 15 minutes, Dr. Chetan. If you want, we can take a few questions. At 7 o'clock, we'll bring this program to an end, sir.
Sure. Thank you so much, Team Marcellus. Definitely, it is really a takeaway because all the time, though we know some of the things, what we do is we will be really looking for bottom fishing. So which is really a not possibility. That is what you guys in fact told us, unwrapped in your video, in this particular session with us, definitely. So I would like to ask you, we have got a few questions here in fact. So what is the importance of intrinsic valuation with respect to your strategy? Because we learn here in the B school, we teach, in other words, students also understand what is intrinsic value and all that. So what is the importance of it? Or to any one of you can take this question.
Salil, do you want to address that importance of intrinsic valuation in the context of what we do?
Yeah. Right. So, see, relative valuations, the most popular ways that most stock market participants use to value companies is using a price to earnings or an EV, EBITDA, or some multiple, which are all relative multiples, right? It tells you a stock is more expensive than some other stock, not necessarily what its intrinsic value is, right? Plus, these relative valuation techniques have a lot of inherent flaws. They ignore reinvestment risk. They look at earnings, not cash flows. And earnings, like we've been saying so far, it's very easy to manipulate. Lots of frauds in India. So intrinsic value is critical. We also follow an intrinsic value method. We prefer to use discounted cash flow. That also has its own challenges because you have to forecast for the long term, and the farther out you go into the future, the more difficult it is. So what we do is the process really starts with identifying what are the core competitive advantages of a company and whether these are sustainable or not, because that is what is going to tell you is that how much the longevity of a business and its ability to earn a return on capital which is greater than its cost of capital, which allows you to make a cash flow, which is kind of make you positive cash flow, which can be reinvested back into the business, and that cycle goes on and goes. So we have two parts to this. One is figuring out these qualitative aspects and then translate that qualitative into a quantitative number in terms of how many years of competitive advantage do you see where these cash flows can continue. Once we have that, then we do a DCF and try and arrive at an intrinsic value. That really tells us what is kind of the absolute value of a business, rather than trying to compare it with some other businesses or some other companies.
Okay, thank you, Salil. There is one question which is coming from Yash. So as students focus on swing trading? It's not about investing, is asking, but I think it's a wrong question for you guys, I guess.
The last swing I saw was on the playground when I was 6 years old. I don't think any of us know what this swing trading business is.
So definitely, so students definitely they should actually eye upon long-term investment given a chance. And there is one more question which is coming up. So
no, Dr. Chetan, that's the wrong thing. Let them go and bankrupt themselves. No, सीखने दीजिए. Let them go and bankrupt themselves. फिर अकल ठिकाने आएंगे.
Yeah, so we are teaching them how to actually make a consistent compounders, how to actually make money. But if they want to get bankrupt, definitely something of that sort would
At this stage of life, Dr. Chetan, if you tell a youngster, he'll do opposite of what you will tell him. So tell them कि जाओ बर्बाद करो अपने आप को swing trading करके, then they will do consistent compounding.
Okay. So there is one question which is coming from Rohit. Sir, while investing for a long term, shall we have to put a stop loss? Maybe how to exit, the point to exit, maybe something like that we can actually think of.
Then we don't use stop loss. How will you make money if you're thinking about stop loss? Then पैसा कैसे बनेगा? So stock ऊपर जाएगा, नीचे नहीं जाएगा. Even the best companies in India go down 30, 40, 50% in a year, right? I can recall off the top of my head, even great compounders like
Asian Paints, in fact, it has touched
HDFC Bank, Asian Paints,
2,500 something.
repeatedly
50%.
Yeah. So again, another bit of useless thing, stop loss. Again, लगाइए, बर्बाद कीजिए अपने आप को, फिर सीखोगे आप लोग. This is all the useless stuff that Bombay teaches you: stop loss, swing trading. Keep doing this. As you become poorer and poorer through your 20s, you'll learn most of this is nonsense.
Yeah. So there is one more question which is coming up, sir. Can you please just a minute? We have startups are highly valued nowadays, even they are loss making when they are registered for IPOs. So what are your opinion? Like, for example, we have got a Zomato for that matter. So the cash flows and all, if you really see, it is unpredictable. At the same time, company
There was no mention of startups in our book notes. So Rakshit and I have written coffee can investing. Salil, Rakshit and I have written
diamonds in the dust.
Diamonds in the Dust. I've also written Unusual Billionaires. I've never heard anybody tell us that the route to wealth is by making losses. Rakshit spoke about in his slide about great capital allocation. So again, it's a sort of a bizarre notion, and I haven't actually seen. Rakshit, have you seen any Indian company compound wealth whilst making losses?
No, you can't.
So हुआ नहीं है डॉक्टर चेतन, so your students will know हुआ नहीं है इंडिया में कि losses बनाते बनाते हमने wealth बना ली है. Hasn't happened in India. Maybe it will happen. You never know these days. Disruption ऐसा जबरदस्त हो सकता है that after insane losses, a startup creates huge wealth, but we haven't seen it happen.
Okay, so how to analyze the risk in the long-term investing? This is the question.
That's a lovely question. How to analyze the risks in long-term? Rakshit, you want to attack that lovely question actually?
Yeah, that's need a lot of depth in thinking through the answer. In fact, so let me sort of make an attempt at first of all classifying risks into 3 or 4 different buckets. The first and foremost risk is the risk of fundamentals of the underlying business that you're investing in, right? And that risk can further be then subdivided into competitive dynamics as a risk, complacency as a risk, capital misallocation as a risk, or say exposure to or sort of lack of exposure to macro as you compound, so on and so forth, right? External environment. So to begin with, I think the biggest risk that you have to mitigate in investing is by moving away from this fundamental risk. You should invest in companies where the company is good enough to take care of competition, take care of disruptions, take care of capital allocation decisions, prudence, so on and so forth, right? So that's the biggest risk that you need to first of all mitigate. The second risk which all investors, particularly in India, need to mitigate is the accounting risk, right? Because as Saurabh, Salil mentioned in their slides, accounting fraud is a massive risk that investors deal with in India. If you don't mitigate it, then even investing in high quality fundamental companies won't allow you to make money, right? So that's the second big risk. And then there's a separate category of risks, which are the sort of risks around the investment decision itself. And that could be, let's say, things like concentration of the portfolio, right? If you end up owning 50 or 100 stocks as a fund manager, unfortunately, you won't get diversification benefits from that long list, but you will get dilution in quality of your portfolio through that long list, right? So that's a risk of a bad investment construct. Likewise, there'll be cases where you're trying to time entry exit. That's a risk you should actually avoid. So those, I would say, are the 3 broad categories of risks: fundamentals, accounting quality, and investment decision making by the investor himself. Saurabh, anything else you want to add on to?
I think just to sort of look at I think this is a really superb question, and Rakshit's answer, I think, does justice to it. So one of the things in Rakshit's answer is he at no stage did he mention the stock price, right? So one of the hardest things to learn in investing, and one of the most powerful things to learn in investing, is the stock price is a useless thing to focus on. So anybody on this call जो निवेश करता है stock price देख के, any of you are investing with a focus on the stock price, you're on the road to ruin, right? The focus in investing, every second, every minute, every ounce of your energy has to go on focusing on fundamentals. Rakshit did not talk about stock price risk. I never understood why people focus on stock price risks. The stock price is the outcome. Never focus on the stock price. Focus on underlying धंधे पे, accounts पे, business पे focus कीजिए, right? And that the inability to focus on fundamentals This constant obsession with the stock price and the inability to focus on fundamentals, it is what ruins 99% of Indian investors. Sari zindagi stock price ताकते जाते हैं. They don't study when they are in business school. They don't study after they leave business school. Sari zindagi is swing trading or day trading or stop loss and FNO में बर्बादी के सारे लक्षण वहीं पे दिखते हैं.
Okay, so there is one more question. So can you tell us what are the screens you use for doing your financial analysis? Can you disclose your screens to us? Is a question coming from.
Do you want to give a sense of how the forensic screens work and how our capital allocation screens work?
Yeah, so right. Yes, so we start with kind of two screens. And the first screen that we use is what Saurabh mentioned, a forensic screen. So what we do is we take all companies in say a wider index like say PSE 500, right? So that gives you a set of 500 odd companies. We rank all of these companies on certain set parameters. In fact, the book lists what these parameters are. So we look at accounting ratios, could be something as simple as how fast is auditors' remuneration growing compared to the growth in revenues, right? A faster growth in auditors' remuneration versus the growth in revenues tells you that there is something fishy. Right? If the scope of work is not increasing, then audit fees should also not increase. So set of simple ratios, but all put together, they become a very, very powerful tool. So once we put these companies through a screen, I would say more than 50-60% of the companies get eliminated because they score poorly on accounting ratios, poor on account, not just disclosures, but even on outcomes. Right. So that's the very first step. So this again is telling you where not to invest. So that's one screen that we run. The companies which clear this screen go through another screen, which what we call as the greatness screen or capital allocation screen. So this tells us that in history, how has this company used surplus cash flows from its business into growing its own business, right? So you need to do two things. One is you need to reinvest the cash flows to kind of strengthen your competitive advantages. And second is to grow or to invest for growth in the future, right? So this could be done through, say, new growth drivers that you could seed, adjacencies either in products or in markets, and so on. Right? So that's the second screen. Now, this screen again tells you that out of the companies which clear the forensic screen, how many have made good use of capital? Because over the long term, that is the single most important item that will drive value creation. Right? So these are the two screens that we use. Again, what we use for capital allocation in the book, there are plenty of examples that will give you an idea of how to go about this. And these are very easy to build, right? If I'm sure all of you are kind of very technically kind of more oriented than we are, and you can run this by yourselves.
So there is one question.
Just to be clear, just to be clear, there are no screens on PE multiples, PB multiples, EBITDA, 5-year trailing, this 5-year trailing, none of that. Share price has zero predictive power. Right? Share price does not form an important part of the investment decision. I heard somebody reference Benjamin Graham. Benjamin Graham wrote a book around 80 years ago for a different country. Right? So one of the biggest follies in Indian investing is to use foreign books to study in India. It doesn't work. The more you use foreign books to study, invest in India, the greater the challenges. And Dr. Chetan, my request to you, you guys are running a distinguished faculty, get rid of foreign books in teaching Indians investing. It doesn't work. Bringing foreign material, it works. American books are written for the American market. They're not written for the Indian market. India has a different accounting construct. Our macroeconomy is different, and hence we need to use Indian books to study finance in India.
Yes, definitely. So last question. So coming from Mr. Devesh. So we have Bloomberg Finance Lab at our institute. So what student projects would you suggest for us to take it up?
All right, so plenty you can do. So you guys are in a vibrant part of Bengal. So I'm pretty sure Murshidabad is a vibrant district. So one simple exercise would be choose a company that you guys are considering investing in. Read 10 years of annual reports. So you can choose a laminates company, a pipes company, a building materials company, a biscuit company, whatever. Choose a company where the team, whichever is the research team, reads 10 years of annual reports. Use the 10 years of annual reports to build a picture of firstly accounting quality, Secondly, the strength of the franchise, basis the annual report, how powerful does the franchise look like? And then go out into the marketplace, meet wholesalers of that company, distributors of that company, meet dealers of the company, and ask them, माल कितना बिकता है इस कंपनी का, किस भाव पे बिकता है. You'll need to talk in Hindi. None of this English will work over there. Go to the dukans, go to the bazaars of Murshidabad, go to wholesalers, distributors, and dealers, and understand what is the price premium the company commands. Why is it able to command that price premium? Why can't competitors match that company? Right. So read the annual report to build the picture as per the annual report. Right, understand accounting quality. If it matches up on accounting quality, look at return on capital, look at free cash flows, look at reinvestment free cash flows. Build your picture first basis the annual report. Build your hypothesis on the greatness of the company. Then go into the bazaars of Murshidabad, go into the marketplaces, go to go downs and warehouses, and figure out why is this company able to charge such a massive price premium, and that will give you your sense of how actually investing works. You won't ever have to look at PE multiples uske baad.
Yes, thank you so much, Team Marcellus. For definitely it is an eye opener for all of us, because all of us were actually quite impressed with these stock prices all the time. But you guys told us that stock price is nothing but useless piece of information for all of us.
I've got an auto rickshaw stand in front of my house. The fellows sitting in the auto rickshaw, those guys are also looking at the stock price. So looking at the stock price made him money. The poor fellow wouldn't be driving an auto rickshaw. Right? You guys are studying in a prestigious business school. Yeah, you shouldn't be looking at stock prices. The most useless thing to stare at.
Yes.
And we have, Saurabhji, we have Bloomberg terminals. We have
Absolutely.
finance lab consist.
So that's a waste of money. Bloomberg terminal में तो stock price ही है ना. Bloomberg terminal से 25 लाख का खर्चा बेकार है. So
आपने ठीक ही कहा कि annual report, pick up the annual report of a company, read it carefully and all the accounting practices and all about the variables and financial variables.
10 साल का annual report, 8 साल का नहीं, 10 साल का. 10 साल का.
Understand the concept and go to the market and go to the nearby warehouses and check out their annual report and try to see that what are the variables they are using for valuation of their stocks and valuation of their prices, etc. Probably probably the students will be able to understand a lot of gap between exactly theoretically what is there in the annual report and exactly in actual practice how these businessmen are following. So to start with, the students can learn from their live projects. Dr. Chetan, if you can give them some live projects, industry live projects, actually the students can go to the market and go to their various industries, small industries in Murshidabad, even it's the food processing industry or whatever, and they can collect the data from there, and then probably what Saurabhji and Salil and Rakshita are talking, they would be able to correlate. You see, they have in their book, they have very well explained about the salient features of consistent compounding as well as the regular compound. Today, I came to understand that the salient features, and that is a powerful feature, and that is a consistent compounding will be better than the regular compounding, and therefore as to how you are going to protect your earnings. And I am really amazed to see that Rakshit and Salil, both of them have very well explained about the various concepts relating to pricing power, accounting quality, some CAGR, or the capital allocations as are, etc. are some of the important features for the allocations of your business portfolio in a different segments. In that context, in fact, Rakshit has talked about various aspects of the what is called these risks. And among the various aspects of the risks, the financial risk is something very important. But within the financial risks, they have highlighted about the accounting fraud. And India has been suffering from the accounting fraud right from Satyam onward, DHFL, etc. And therefore, the poor investor, सौरभ जी ने ठीक ही कहा, जाओ अपने को बर्बाद करो अगर तुम इन्वेस्ट करना चाहते हो ऐसे कंपनी में जो क्विकली ग्रो कर रहे हैं, जिनका कोई प्राइस और स्टॉक को देखते हो, तो तुम थोड़ी दिनों में 1 साल 2 साल में रिच बन जाओगे, लेकिन तुम डस्ट होने वाले। सौरभ जी ने ये कहा तुम डस्ट बनोगे, डस्ट बनने के बाद तब तुम अंडरस्टैंड करोगे अब क्या बचा, अब कहाँ जाए, क्या करें। तो therefore I am grateful to you, सौरभ जी, आपने ये बच्चों को समझाने की कोशिश किया, आपने try to understand them that guys, you are reading in a book, published in America or published in Europe, And those concepts are no longer applicable in Indian context. And you have rightly mentioned that if you want to invest in India, you read Indian books.
बिल्कुल सर.
Indian books, which gives a genuine, truthful comparison of the competition analysis as well as the risk analysis of the various companies, not based on BSE or NSE. Isn't it? And therefore, today we have understood that stock price पर focus ना करें, सौरभ जी ने कहा. Otherwise, you will ruin yourself. सौरभ जी ने ये भी कहा, और सौरभ जी ने ये भी कहा, तो आप किस पे फोकस करेंगे? बिजनेस पे करें. Therefore, what Saurabh ji is trying to highlight है कि आप अगर अपना एंटरप्रेन्योरशिप, छोटी छोटी कंपनी, वेल्थ जनरेशन के लिए सोच रहे हो, खोलना चाहते हो, तो बिजनेस पे पहले फोकस करो कि हाउ योर बिजनेस शुड ग्रो against the competitors, and therefore what are the portfolios that you should give more importance than your greed. See, greed, I'm using the word greed for making quick money, वो चलेगा नहीं, चलो ना. Greed for making money चलेगा नहीं, इससे आप wealth manager, a wealth creator नहीं बन सकते हैं. You have to be in the game, you have to go for a long-term game, and therefore it's not that it's a game, it's a psychological game that you have to understand. Various permutation, combinations, and the mathematical analysis, and then you go to मुर्शिदाबाद के मार्केट में जहां पर वो लाला का दुकान है, वो देखिए कैसे वो बैलेंस शीट बना रहा है अपना और कैसे इन्वेस्ट कर रहा है. I always try to tell my students that if you really want to become a great wealth generating sort of company in our country, and if you really want to make a tremendous contribution to the cause of nation building, and I think you start from the scratch. जैसे सौरभ जी ने कहा, just बनो पहले, just बनो और जाकर के देखो कैसे पैसा बनाया जाता है. Am I right, सौरभ जी?
बिल्कुल. Atmanaji, you hit the nail on the head. So grateful that you pulled together all the threads of what we said. बहुत शुक्रगुजार है सर, आपने बहुत प्यार से समझाया अपने छात्रों को. Thank you.
Thank you so much. Yes. So, Director sir, with your kind permission, shall we close this with a vote of thanks?
Yes, please.
Thank you.
Thank you very much.
So, yeah, thank you. So I thank Mr. Saurabh Mukherjee, Mr. Rakshit Ranjan, and Mr. Salil Desai for accepting our invite and raise the occasion with their investing insights. I thank Professor Dr. Atmanand, Director MDI Murshidabad, for attending the webinar and encouraging all of us to take up the very new initiatives as well. So I thank Professor Garanchi Narayaneshwar, Dean Continuing Education, for attending the webinar. I thank all the professors and non-teaching staff of MDI Murshidabad for attending the webinar, and also would like to thank my dearest student for attending the webinar with utmost zeal and passion. So finally, I sincerely appreciate and thank Mr. Sayantan Sinha, Mr. Joydeep Mukherjee, Mr. Avirup Das, and Ms. Dayavanti for being in the background and assisting in all the interviews. Thank you so much. So we're signing off.
Thank you.
Thank you. Thank you.
Thank you.